So I used to hate sideways price action, ranges, or accumulation areas. And that's because I used to get caught in the most common and obvious market traps. Nowadays, whenever I see two equal points or a previous swing with a liquidity run and another opposite swing, I know there are money to be made. I call it the expanded range phase. The expanded range phase becomes easy to trade if you consider how traders' feelings affect the way they buy and sell in the market. Let's begin with the idea that when prices seem low, people who want to buy show up. This creates an area of demand. These buyers make the market's price rise to a point where they feel it's too high, and then people who want to sell start showing up. When these sellers step in, the market's price goes down again, leaving a supply area behind. Now, in a sideways price action phase, the market's price sort of stays in the same range without going up or down much. This creates a kind of zone that the price doesn't go above or below too much. It's like the market is staying in a certain area. Now let's pretend you started by selling at point A in the market. Then, as the market dropped to point B, you decided to close the trade for a profit. Now, think about how you feel about this initial sell trade at point A. Since it turned out to be a profitable trade, you would feel happy, especially when you exited at point B and got a profit. Now imagine if you didn't sell, but instead you bought at point A. How would you feel as the market went down towards point B? You might feel frustrated and even angry at yourself and at the market for not going the way you wanted. And as the market keeps going down, you would feel like you're losing money, and that's painful. You might hope that the market will go up again, so you can at least break even and feel better. You might even promise that if the market gets back to where you bought, you'll exit the trade. And that's because getting back to where you started would take away the pain, the frustration, and the bad feelings from a trade that didn't go well. Remember that our minds like things that feel good and want to avoid things that feel bad. When the market gets close to the point A, the memories of how you felt at that point will start affecting the people in the market. Those who were happy when the market was at point A will likely do the same thing that made them happy before, which means they will probably start selling. On the other hand, those who bought at point A and felt bad about it will likely do the opposite now. Instead of buying, they'll probably start selling. This is because our feelings influence our actions in the market, and there will be another group of people in the market who didn't sell when the market was at point A, and they felt bad watching it drop to point B. This group is likely to sell when the market tries to go back to A again, because they want to capture the good feeling they missed before. In this situation, A becomes a strong supply area that stops the upward movement of the market. Following the same ideas, we can also guess that in the future, when the market tries to go down from the supply area, there will be buyers who remember feeling good when the market was at point B. The sellers who initially sold at point B and felt bad will now do the opposite and buy. Also, those who were just watching before will now want to buy because they don't want to miss out on the chance for profit and good feelings. In this case, point B becomes a demand area that limits how far the market can go down. Now, if you think logically and consider your experience, you'll understand that finding a perfectly balanced sideways market is not very common. Our world and the market we trade in are not perfect, so this situation doesn't happen often. What's more likely is that the upper limit, the supply zone, and the lower limit, the demand one, of the sideways market might change over time. Sometimes, the market might get very close to the supply and demand areas, but not go past them. Other times, it might go beyond those zones and then come back into the sideways pattern. And this is how an expanded sideways range develops. And this phase is a valid and practical one for trading. It's strong because it's built upon how traders think and behave. Remember, they lean towards gaining pleasure and avoiding pain. So you can create a trading plan with clear steps for when to enter and exit trades. The first step is to figure out the current sideways price action. You focus on the area near the top or the bottom of this range. First, you find the most recent highest and lowest points on the chart. The upper or the lower range must have an area with equal lows or two swing points very close together. Let's say we found this possible range with two approximately equal highs. If the market is close to this low point, we're watching to buy when the range gets bigger, but the price doesn't keep going down. A liquidity run below this swing low, a fake out. You mark this demand level to the right side of the chart. This line will show you the current bottom level of the sideways range. It will help you to see if there's any attempt to break out of this range and can also act as a signal to show if the market is going back into a sideways pattern. After that, you need to wait for a breakout. This means the market should go to a new low that's even lower than the current swing point, a liquidity run. For the scenario of range expansion to be more likely, the market has to close above the previous swing point. So you enter a buy trade when the market closes above this level. Now let's come back to the psychology of traders during a live trade. When traders make a profit, they often feel pressured to take that profit immediately. This is because they fear that if they don't, the profit might turn into a loss. As a result, they take small profits when their trades are positive. On the other hand, when their trades are negative, they hope that the situation will reverse and the loss will turn into a profit. And sometimes this works out. But often, the market goes against them, leading to even bigger losses. And this is why most traders fail. It's so obvious. They end up losing more money than they make. So to be in the 10% club, your profits need to be bigger than your losses. You need to be willing to accept small losses quickly to avoid bigger ones later. To achieve this, you need to use the average true range. The ATR will help you set a limit for your losses. The ATR is a calculation that considers price movements over a certain period. In our case, we'll use a 50 candle time period to determine this limit. Think of the ATR as a kind of protective shield. It helps you handle the risk and potential loss of a trade. You're okay with a certain amount of movement against you as long as it stays within the ATR range. However, if the market moves against you more than the ATR, it suggests that the situation might have changed and the market could be heading in a different direction. In our example, after identifying the new low point, we'll use the ATR to set a point below that low. This is where you'll decide to exit the trade if it goes against you. We're buying, so our stop loss point will be below our entry point. The formula for setting the stop loss is the new low minus the ATR. Your exit target will be the highest point, the supply area of the range. And it's smart to take trades that offer better potential rewards compared to the risk. If the reward is not at least double the amount you risk, you might want to reduce your lot size, or even skip the trade if the reward is lower than 1.5. And here are the steps for a short trade during a range expansion phase. You first figure out where the lowest and the highest points of the sideways price action are. The demand area must have at least two swing points located around the same area. You want the market to go above the supply area of the sideways phase. If the market closes below the previous highest point, you sell at the close. You look at the 50 ATR, and as you're selling, you set the stop loss by adding the ATR to the new high point. The profit-taking exit rule is simple. You target the demand area of the range expansion phase. So as you're selling, your exit point is the lowest point of the sideways price action. And remember, only take a trade if the potential reward is at least 1.5 times bigger than the potential loss. A risk to reward of 2 would be the sweet spot. So this is Bitcoin on the hourly time frame. The first step is to draw the limits of the current sideways range. You look for the most recent highest and lowest points on the chart. The upper range is an area with several equal highs around the same area. This is your supply level, and this is the most recent low point from which the market made an important move up, the demand zone in our setup. If the market comes close to this low point, we are watching to buy after a liquidity run below the swing low. So when the range gets bigger and the price doesn't keep going down, you want to see an attempt to break out of this level, but the market must go back into a sideways pattern, ideally within the next 2 or 3 candles. When this happens, the range expansion is completed. We had the liquidity run below the swing low, and sellers were trapped as the market closed above the previous swing point. And you enter a buy trade, hoping for an upward momentum. You look at the ATR value to set a stop loss below that liquidity run. As you're buying, the stop loss point would be the new low minus the ATR. You can also set it at your entry point minus the ATR, and this would be a tighter stop loss. But I recommend you leave the trade more room to breathe. Your exit target will be the highest point, the supply area of the range. In this case, it was a risk-to-reward ratio of almost 2. If you can align the liquidity run with the previous trend, that's even better. So this is pound yen on the 15-minute time frame. We see that the previous trend was down. We had lower lows and lower highs, and now we're in a potential range phase. If we look at the most recent highest and lowest points, we see that the lower range is an area with several equal lows around the same level. The market failed to make new lows, and that's the first sign that the range might follow. This is your demand area, and this is the most recent high point from which the market made an important down leg, the supply zone in our setup. If the market reaches this high point, we're planning to sell after a liquidity run above this swing high, and it's a good setup because we're also in a minor downtrend. So this fake out above this point is an excellent area to capitalize on trapped buyers. So we have an attempt to break above this level, and the market returned back below the supply zone within the next candle, which is an ideal scenario. The trade checks all the conditions, so the range expansion is completed, a liquidity run above a major swing high in the direction of a previous downtrend. So you enter a sell position, hoping for another downward leg. You then look at the ATR value to set your stop loss above that liquidity run. As you're selling, the stop loss point will be the new high point plus the ATR value. Again, you can also set it at your entry point plus the ATR, but in some markets, the price will sometimes move above the previous high once again. Your exit target will be the lowest point, the demand area of the range. A valid trade, as it offers a risk-to-reward ratio of almost 2.